In this video, we want to kind of conclude our financing discussions with, how does this work in real life, right? Do we have any answers? And quite frankly, before we even get to the end, I will tell you that there's no real answer, right? As we mentioned in one of the previous videos, the decision to finance with debt or how you finance is a very complicated process. There's many factors involved. There's factors from within the company. There's factors even from within the company, within management. There are factors in the marketplace with the values of security. So it's a very complex process. So we've been talking about this trade-off theory, tells us how we should choose our structures. But that doesn't necessarily match with the idea of what companies actually do in practice, right? What do they actually do? So this entrenchment theory we've talked about previously suggests that you should choose a structure to avoid the discipline of debt and to maintain your own job security, right? So managers might seek to minimize leverage to prevent the job loss that might come with financial distress. So maybe this is a reason why companies tend to have a lot less debt than what the theory should say that it should have. So let's explore this a little bit. We're going to talk about something called the asymmetric information and how that affects capital structure. Asymmetric information just means somebody has more or superior information than others. And of course, in the corporate context, managers have superior information to investors. So there's what we refer to as the credibility principle. This claims that one's self-interests are credible only if they're supported by actions that would be too costly to take if the claims were untrue. In other words, how this boils down to real life is that managers will not lie to shareholders, right? They won't provide us with false information because the cost of that would be way too expensive for them should somebody find out about that. So assume we have this company has a new profitable project, but it can't talk about this project for competitive reasons. How can management get information? This is positive. This is great information. How can they get that to owners if they're not allowed to tell them exactly what it is? One of the ways might be to borrow a substantial amount of money. If the information is true, the company would have no trouble making the debt payments. If the information is false, then they're going to have trouble paying, and of course, that could mean their job, right? Financial distress. And that distress not only is costly to the firm, but now it is also extremely costly to management. So in other words, management can only lie to you one time, and then they will forever lose their credibility. So the use of leverage as a signal is very important, right? They can use this to convince investors that it has information. Management has information that the company will grow, but they can't tell them because of proprietary or secret information. So we have what we refer to as adverse selection and the lemons principle. If a seller has private information about the quality of a car, right? They want to sell this car, right? So his desire to sell reveals the car is probably of low quality, right? If you really want to sell, right, it might be a sign that there's something wrong with the vehicle. So buyers are going to be reluctant to buy, except at heavily discounted prices. So the owners of high quality cars, it's harder to get them to sell because they know if they're really trying to sell, right, lowering the price maybe even or putting pressure on, right, they know buyers are going to think it's a lemon and they're going to offer a lower price. So the quality and prices of cars sold in the used car market are usually lower. Why are they lower? Because the purchasers think that there's something possibly wrong with those vehicles. So again, we can kind of apply this to equity, right? The owner of a startup company offers to sell you 70% of his stake in the firm. He states he's only selling this because he wants to diversify. But you're suspicious. And because you're suspicious, you may offer them a lower price, right? You may think he's trying to cash out. Therefore, you're going to offer him a lower price for that equity. Again, he has private information. He knows about the quality of future projects. So again, this lemons principle is going to force potential investors to discount the price. So managers who know their prospects are good don't want to sell new equity. They don't want to issue stock. Only managers who know their firms have poor prospects are willing to sell new equity. And I think this makes a little bit of sense if you think about investors, right? Investors would never sell stock that they thought had potential for future growth. You would only sell stock if you assumed it had reached its peak and could only go down, right? So there's something wrong with it, so it's going to go down, right? Thus, the only time you would really want to sell your stock. So this lemon problem creates a cost for firms when it wants to raise capital. If they try to issue stock, investors see it as a bad thing, that investors have bad, or managers have bad news, and they're going to see this and reduce the price that they're willing to pay. So again, how do we conclude this, right? Stock price declines on the announcement of an equity issue, right? It tends to rise prior to the announcement of an equity issue, but then as soon as the issue information is provided, there's going to be a reduction in the value of the stock. So managers who perceive firms' equity as underpriced have a preference to fund investment with retained earnings or debt rather than equity. And the converse is true, right? So this brings us to what we refer to as a new theory, right? This theory kind of tries to explain how management really thinks. This theory, the hypothesis here, is called the pecking order hypothesis. So the idea here is that managers prefer to fund investments first using retained earnings, then debt, and equity only as a last resort. I mean, the challenge here is it doesn't give us a clear prediction of capital structure, right? Because retained earnings is equity. So what they're saying is they prefer to use internal equity rather than external equity. In fact, they rarely want to use external equity. It's just merely retained earnings is another form of equity financing. So companies might have low leverage, either because they're unable to issue debt and they're forced to on equity financing, or because they're sufficiently profitable to finance all the investment using retained earnings, right? So it's kind of a strange situation. But let's see if we can make some sense of how this would work. So again, the pecking order theory, it says there's one rule. We're going to use internal financing first. Now, this now dovetails this financing issue with dividend theory and investment opportunities. So now we also have to consider another whole aspect, too, actually, of business, right? How much dividend should we pay? And how much, what are the investment opportunities for the firm? Rule 2 says, next, if you need to, you would issue debt, and then finally, and then only as a last resort, issue new equity. So this pecking order theory is kind of at odds with the trade-off theory, right? There's no target debt equity ratio. Profitable firms use less debt. Companies like to have financial slack, right? They like to have the ability to borrow, but they don't really want to borrow unless they have to. So let's go through an example here to try to finish this up. So Myers was a researcher, and he talks about he's trying to explain why maybe this asymmetric information theory can explain how managers actually work. So, the trade-off models assume investors have homogeneous information. Everybody has the same information. So here's our example. We have a stock worth $19 and they have 10,000 shares. But managers know that the true value of the stock is $21. When other investors find out this true value, of course, the stock's going to move to that value. Management determines a $5,000 net present value project, and the project's going to cost $100,000. So let's assume we live in a world, again, with symmetric information. So if everybody knows about this project and the value, the stock price is going to move to $21, right? So they want to issue now, they would want to, I'm sure there should be a word here, they would want to issue 4,762 shares. That's $100,000 for the project divided by $21. So what is the new stock price? Well, here's the value, the original market value, 210, plus the new value that they raised, plus the net present value, divided by the number of shares. So this new stock price would be $21.34. So in this case, because we have symmetric information, everybody knows what's going on, the firm, if the firm does the project, there's two categories of shareholders now, the old shareholders and the new shareholders. In this case, they both gain 34 cents. But we don't live in that world. We live in an asymmetric world. You don't know about this project until it is announced, right? So in this case, because the stock price hasn't changed yet, you're going to have to issue more shares. So the new stock price is $20.64, right? Now, again, who do you work for? Today's shareholders or tomorrow's shareholders? And the answer, of course, is you don't know who tomorrow's shareholders are, so you don't work for them. In this case, the value of the company is $21, remember? But the new stock price is going to be $20.64. So the old shareholders actually lose 36 cents in value. It was worth 21, now it's worth 20. But the new shareholders, since they only paid $19, they gain $1.64. So in a world with asymmetric information, issuing equity, right? Issuing equity, any benefit that's gained, at least in this instance, goes to the new shareholders, not the old shareholders. What if we just had a more profitable project? What if the net present value was $20,000? Now the new stock price is $21.62. So now everybody gains, but the new shareholders gain much more than the old shareholders. So what is the net implication here? The implication is if you issue stock to purchase investments, the old shareholders, if they gain at all, they gain less than what the new shareholders gain. So with asymmetric information, you should only issue stocks if you have a very profitable project that cannot be delayed or financed with debt, or if you think stocks are overvalued. Now, of course, investors recognize this, right? And they're going to tend to mark down the share price when firms issue shares. They see issuing shares as a bad signal. So the pecking order makes sense with asymmetric information. It pays to return a large fraction of earnings, to keep the debt ratio down, and to reserve some borrowing capacity. So what are the assumptions, right? Managers act in the best interest of existing shareholders. Information asymmetry exists between managers and investors. So there's two predictions that we can make. Firms hold financial slack so they don't have to issue securities. Firms follow the pecking order, right? We're going to use retained earnings. We will sell low-risk debt first and then equity only as a last resort. So the optimal capital structure depends on market imperfections, taxes, financial distress costs, agency costs, and asymmetric information. So I think you can see here that hopefully that this decision is a very complex decision that has lots of variables involved. I think this is why even within industries, you see a wide range of capital structures. It's dependent on the management team and how they assess these market imperfections. That's going to drive their capital structure. So again, it's a long ways to go to not have an answer about what to do. But there's lots of things for us to think about. I look forward to seeing you in the next video.